The line Japan just crossed. Japan just crossed a financial line that hasn't been crossed in 30 years, and almost nobody outside bond desks understands what that means. On January 20th, 2026, Japan's 30-year government bond yield hit 3.9%. That is the highest level since these securities were created in the 1990s. For 3 decades, Japanese long-term rates were suppressed, contained, engineered into submission. Investors were conditioned to believe they would stay near zero forever. That belief just broke. Now, if you're not a bond trader, 3.9% doesn't sound dramatic. It doesn't sound like something capable of destabilizing global markets. It sounds technical, boring, distant. It's not, because Japan is not just another bond market. Japan is the anchor of the largest liquidity machine in modern financial history. For 30 years, the world operated on a simple equation: borrow in yen at zero, deploy globally at higher yields, collect the spread. It was the cleanest trade in finance. It funded hedge funds, it funded private equity, it funded tech expansion, it quietly supported U.S. treasuries, U.S. equities, and global risk assets. That equation no longer works. And when a 30-year equation breaks, the unwind doesn't happen gently. It happens violently. Let's look at what actually changed. In December 2025, the Bank of Japan raised its policy rate to 0.75%. Still low by historical standards, but the highest Japan has seen in 30 years. More importantly, they abandoned yield curve controls, the policy where they bought unlimited government bonds to suppress long-term yields. For decades, Japan acted as buyer of last resort, artificially suppressing volatility, guaranteeing liquidity, removing risk. That backstop is gone. And when the buyer of last resort steps away from a 250% debt to GDP system, the bond market reprices immediately. The 10-year yield surged from 0.5% to over 2% in less than 6 months. The 30-year exploded to 3.9%. Moves of this magnitude in sovereign bond markets are statistically extreme. 6 sigma events. The kind of moves that are not supposed to happen in stable developed economies. Yet here we are. Now, here's the part that should concern you directly. Japan holds $1.2 trillion in U.S. Treasury bonds. They are the largest foreign holder of American government debt. For decades, Japanese banks, insurers, pension funds, and institutions recycled domestic capital into U.S. bonds because the spread was easy and predictable. Borrow at zero. Buy treasuries at 4% to 5%. Hedge currency risk repeat. But if Japanese government bonds now yield 3% to 4% at home, why take currency risk? Why send capital abroad? Why absorb volatility when nearly the same yield exists domestically? You wouldn't. No rational institution would. And when that logic flips, capital flows reverse. This is where it stops being theory. When capital reverses, assets must be sold. Not gradually, not politely. Sold because the math demands it. And we already saw a preview. In August 2024, a minor surprise rate move from the Bank of Japan triggered a partial unwind. Bitcoin dropped 23% in 3 days. The Nasdaq fell 10%. The S&P lost nearly 8%. Over $2 trillion in market value evaporated in 72 hours. That was a tremor. What we're facing now is the structural shift, because this time yields didn't tick higher temporarily. They reset higher structurally. And once the carry trade becomes unprofitable, it doesn't pause. It unwinds. The world has been built on borrowed yen liquidity for 3 decades. That liquidity is now being called home. And when the funding currency of global risk rises, leverage shrinks. When leverage shrinks, markets fall. This is not fear. This is math. And math does not negotiate. The carry trade, the machine behind the market. To understand why this matters, you need to understand the machine. For 30 years, global markets weren't just rising because of innovation or earnings growth. They were rising because of funding, cheap funding. Japan became the funding source for the world in the late 1990s. After its asset bubble collapsed, interest rates were cut to zero, then below zero. They stayed there for decades. 0% money is not neutral. It changes behavior. When capital costs nothing, leverage expands. Here's how the carry trade actually worked. Step 1, borrow yen at 0%. Step 2, convert yen into dollars. Step 3, buy U.S. treasuries yielding 4% to 5%. Step 4, hedge the currency exposure. Step 5, collect the spread. On paper, this looked almost risk-free. Borrow at 0, earn 5. Clip the difference, scale it up to billions, and you have a consistent return engine. Scale it up globally, and you have the foundation of modern liquidity. Japanese pension funds did it, Japanese insurers did it, global hedge funds did it, prime brokers financed it. And then leverage entered the picture. If you can earn 4% on a spread, what happens when you leverage that position 10 times? You earn 40%. At 20 times leverage, you earn 80%. This is how the carry trade stopped being a quiet institutional strategy and became a systemic pillar. It wasn't just Japanese capital buying US treasuries. It was leveraged global capital amplifying the trade through repo markets, swaps, and derivatives. No one knows the exact exposure because much of it lives in shadow banking, hedge funds, family offices, structured products. But estimates from major banks suggest total leveraged exposure tied to yen-funded carry trades could range between 15 trillion and 20 trillion. That number matters because when leverage unwinds, it does not unwind in proportion to principal. It unwinds in proportion to exposure. Now ask yourself a simple question. If Japanese government bonds yield 3.7% at home, nearly the same as US treasuries, why would any rational institution accept currency risk and cross-border exposure for a marginal spread? You wouldn't. The risk-adjusted return collapses. And once the risk-adjusted return collapses, the trade must be closed. Closing the trade means sell US treasuries, convert dollars back into yen, repay borrowed yen. But that's only the first layer. Because the trade wasn't just treasuries, hedge funds used the same funding to buy tech stocks, corporate bonds, real estate investment trusts, crypto assets, cheap yen-funded risk everywhere. So when the funding cost rises, the unwind hits everywhere. This is why August 2024 was instructive. A small rate adjustment triggered a partial unwind. Markets reacted violently, not because fundamentals changed overnight, but because leverage was forced to shrink. Liquidity disappears faster than it arrives. The carry trade was never about Japan alone. It was about the cost of money. And the cost of money in Japan was the lowest in the world for 3 decades. That era just ended. When the funding source of global leverage rises structurally, capital does not remain deployed. It retreats. And retreat in leverage systems is never orderly. It cascades. The carry trade machine fueled global asset inflation for 30 years. The machine just broke. And when the machine breaks, it doesn't gently slow down, it reverses. And reversals in leveraged systems are violent. This isn't a theory, it's mechanics. And the mechanics are already in motion. Now we need to talk about the multiplier. Because when you hear Japan holds $1.2 trillion in US treasuries, that sounds manageable. The US bond market is enormous. Trillions trade daily. On the surface, it looks absorbable. But that $1.2 trillion is just the visible layer. The real risk is the leverage layered on top of it. Modern finance doesn't operate on cash. It operates on collateral. A hedge fund doesn't need $1 billion in cash to control $1 billion in treasuries. It posts a fraction, maybe 5%, maybe 10%, and borrows the rest through repo markets or prime brokerage financing. That's 10x to 20x leverage. And for decades, yen-funded leverage was the cheapest leverage in the world. Here's how it compounded. Japanese institutions bought US treasuries outright. Hedge funds saw that stable flow and said, if this spread is stable, we can amplify it. They borrowed yen at near zero. They bought treasuries yielding 4 to 5%. They financed those treasuries again in repo markets. They layered derivatives on top. The same collateral supported multiple layers of exposure. One treasury bond could underpin several transactions. That's how you go from $1 trillion in direct holdings to $15 to $20 trillion in total exposure. It's not one-to-one. It's systemic, and leverage doesn't disappear quietly. When rates rise in Japan, the cost of borrowing yen rises. When the cost of borrowing rises, margins shrink. When margins shrink, positions are reduced. And when positions are reduced in leverage systems, selling is not optional. It's mandatory. Here's what most investors miss. Leverage doesn't unwind linearly. It unwinds exponentially. If you're levered 10x and the asset drops 5%, you've lost 50% of your equity. If you're levered 20x and the asset drops 5%, you're wiped out. Margin calls trigger forced liquidation. Forced liquidation triggers lower prices. Lower prices trigger more margin calls. That's the cascade. And the cascade doesn't care about fundamentals. It doesn't care if Apple is profitable. It doesn't care if Microsoft generates cash flow. It doesn't care if Nvidia dominates AI. When leverage unwinds, everything liquid gets sold. Because liquidity is what covers margin. This is why the August 2024 tremor was so violent. A relatively small adjustment in Japanese rates caused ripple effects across US tech stocks and crypto markets. Why crypto? Because crypto trades 24/7 and offers immediate liquidity. It's one of the first assets sold when institutions need fast cash. Why tech? Because mega-cap tech stocks are deep and liquid, easy to exit. When leverage unwinds, capital doesn't discriminate. It exits whatever can be sold quickly. Now imagine that same process scaled up. Not a small surprise rate adjustment, but a structural repricing of Japanese long-term yields to multi-decade highs. Not a temporary shock, but a sustained regime shift. The unwind becomes larger. And larger unwinds don't just hit hedge funds. They hit banks that provide financing. They hit prime brokers that extend leverage. They hit pension funds indirectly exposed through structured products. This is how localized stress becomes systemic stress. It's not the direct exposure that breaks the system. It's the leverage multiplier layered on top. The carry trade was safe as long as funding costs remained near zero. That condition is gone. And once funding costs rise, leverage shrinks. When leverage shrinks in a $15-20 trillion ecosystem, markets don't drift lower. They gap lower. The multiplier effect is what transforms a bond market adjustment in Tokyo into a forced liquidation event in New York. This is not speculation. It's balance sheet math. And balance sheet math always resolves itself. The only question is how violently. What forced liquidation actually looks like. Most investors imagine crashes as emotional events, panic, headlines, fear. That's not how they start. They start with mechanics. Forced liquidation is not psychological, it's mathematical. Let's walk through what actually happens when the carry trade unwinds at scale. Step 1, Japanese yields rise. Step 2, funding costs increase. Step 3, leverage positions become unprofitable. At first, funds trim exposure voluntarily. They reduce leverage slightly. They sell a few treasuries. They close a few equity positions. Markets wobble. Then volatility rises. And that's when the second layer activates, margin. When you hold leveraged positions, you post collateral. If asset prices fall or volatility increases, your prime broker demands more collateral. That's a margin call. You don't get days to think. You get hours, sometimes minutes. If you can't post additional capital immediately, your positions are liquidated automatically, not at ideal prices, at market prices. This is where cascade begins. Treasury yields rise because Japanese capital is selling. Rising yields push treasury prices lower. Lower treasury prices reduce the value of collateral posted by hedge funds. Prime brokers issue margin calls. Funds sell equities and crypto to raise cash. Equity markets drop. Falling equity prices trigger margin calls in equity portfolios. More selling, more forced liquidation. This is not about fear. It's about collateral chains snapping. Liquidity disappears in layers. At first, there are buyers. Then spreads widen. Then bids vanish. Prices gap lower, not because sellers want lower prices, but because there are no bids. In normal markets, buyers step in on weakness. In forced liquidation, buyers step away. Because buyers are also managing risk. And risk managers don't step into cascading leverage unwinds. They wait for stability. Now here's where it becomes systemic. Treasuries are the backbone of global collateral. They are used in repo markets to finance everything from hedge funds to banks to corporate lending. When treasury prices fall sharply, the value of collateral across the system drops. That tightens financial conditions instantly. Funding becomes scarce. Banks pull back. Credit spreads widen. Corporate borrowing costs spike. The effect spreads beyond markets into the real economy. Mortgage rates rise. Corporate refinancing becomes expensive. Risk appetite collapses. We saw a glimpse of this in the UK in 2022. Pension funds used leveraged liability-driven investment strategies. When gilt yields spiked, collateral evaporated. Funds were hours away from insolvency. The Bank of England intervened to stop the collapse. Now imagine that scenario, but centered in US Treasuries, the largest bond market in the world. There is no larger backstop. This is why the unwind matters, because it's not just investors selling. It's a chain reaction across balance sheets, and once that chain reaction begins, it feeds itself. Forced liquidation has three characteristics: speed, indiscriminate selling, liquidity vacuum. Speed because margin calls don't wait. Indiscriminate because assets are sold for liquidity, not logic. Liquidity vacuum because buyers retreat when volatility spikes. This is why diversification fails in these moments. Assets that normally move independently suddenly move together. Everything becomes correlated to leverage. If it's liquid, it gets sold. If it's financed, it gets repriced. And if it's collateral, it gets marked down. The carry trade unwind is not a gradual rebalancing. It's a leverage contraction event. And leverage contraction events are violent because the system was built assuming funding would remain cheap. That assumption just broke. And once the assumption breaks, the unwind is not optional. It's mechanical. And mechanical processes don't respond to reassurance. They respond to math. And the math is now moving in one direction. When the hedge breaks, stocks and bonds falling together, most investors believe they are diversified. They own stocks for growth. They own bonds for safety. When stocks fall, bonds are supposed to rise. That's the 60-40 model. That's modern portfolio theory. And for decades, it worked. Because when economic growth slowed, central banks cut rates. Lower rates pushed bond prices up. Bond gains offset stock losses. It created the illusion of stability. But that stability depends on one critical assumption: that government bonds are unquestionably safe. That assumption is now under pressure. Here's why. If Japanese institutions begin selling US Treasuries at scale, yields rise. When yields rise, bond prices fall. That's basic bond math. Now imagine this happening at the same time hedge funds are forced to liquidate equities to cover margin calls. Stocks fall because leverage is unwinding. Bonds fall because foreign buyers are stepping away. Your hedge disappears. That's called correlation breakdown. Instead of stocks down, bonds up, you get stocks down, bonds down. The portfolio isn't diversified anymore. It's concentrated risk. We've seen this before. In 2022, U.S. bonds and stocks both fell sharply as inflation surged and rates rose. The 60/40 portfolio experienced one of its worst years in decades. Why? Because rising rates hurt both asset classes simultaneously. Now layer forced foreign selling on top of that. Japan holds $1.2 trillion in treasuries. Europe holds roughly $3 trillion. If even a fraction of that is sold into rising yields, it amplifies the move. And rising yields hit everything. Mortgage rates, corporate debt, equity valuations. Remember this, stock valuations are built on discounted cash flows. The higher the discount rate, the lower the present value. If the U.S. 10-year yield moves from 4.8% to 5.5% or 6%, valuation multiples compress. Not because companies suddenly failed, but because the cost of capital changed. Now combine that with leverage unwinds. Funds sell equities to meet margin calls. At the same time, bond prices are falling. There is no safe harbor inside traditional asset classes. This is what Ken Griffin was warning about. When bonds and stocks move together, bonds lose what makes them special. They lose their hedge function. And when the hedge fails, risk is everywhere. This is the dangerous phase of market cycles, because most institutions are structured assuming negative correlation. Pension funds, insurance portfolios, balanced mutual funds, risk parity strategies. All assume bonds offset equity volatility. When that relationship flips, models fail, risk managers scramble, allocations that looked conservative suddenly look exposed. This is not hypothetical. The UK pension crisis in 2022 was driven by exactly this dynamic. Gilt yields spiked, bond prices fell, collateral evaporated, pension funds nearly collapsed, emergency intervention was required. Now imagine a similar correlation breakdown centered in the US Treasury market, the largest, deepest bond market in the world. If treasuries lose their safe haven bid because foreign holders are selling and equities fall because leverage is unwinding, there is nowhere traditional portfolios can hide. Cash? Inflation risk erodes it. Bonds? Rising yields punish them. Stocks? Margin liquidation hits them. This is why correlation breakdown is so destructive. It removes the illusion of diversification. And once that illusion is gone, capital preservation becomes the primary objective. Because when both sides of the portfolio fall together, the damage compounds. Not gradually, but rapidly. The hedge was designed for growth slowdowns. It was not designed for funding stress. We are now entering funding stress, and funding stress changes correlations. When funding stress dominates, everything trades like one asset, liquidity. And liquidity, when scarce, moves in only one direction, down. The 90, 180-day window, what happens next? Now we need to talk about timing. Because this isn't a 5-year thesis. It's a liquidity cycle. And liquidity cycles move faster than people expect. When funding stress begins, markets don't adjust gradually. They reprice in bursts. Right now, we are in the early phase. Japanese yields have broken multi-decade levels. The Bank of Japan has stepped away from yield curve control. The carry trade is no longer mathematically attractive. The first tremor's already happened. The question is how this unfolds over the next 90 to 180 days. Phase 1 is what we're seeing now. Bond volatility rises. Currency markets destabilize. The yen strengthens as Japanese capital repatriates. U.S. yields grind higher as foreign demand weakens. At this stage, markets try to stabilize themselves. Strategists say it's temporary. Central banks make reassuring statements. Volatility fades briefly. This creates complacency. Then phase 2 begins. Large institutional players reduce leverage quietly. They don't announce it. They just trim positions. Liquidity starts thinning beneath the surface. You won't see it in headlines. You'll see it in intraday swings. Sudden 2% to 3% moves in major indices. Treasury auctions with weaker demand. Currency spikes that reverse violently. This is the warning stage. Then comes phase 3. Something breaks. It may be a large hedge fund. It may be a regional bank exposed to bond losses. It may be a treasury auction that fails to clear smoothly. But when leverage meets thin liquidity, small sparks become large fires. And once forced liquidation begins at scale, it accelerates. Margin calls compress timelines. Funds sell what they can, not what they want. Stocks fall, bonds fall, volatility surges. This is where most investors panic, because the traditional signals no longer work. Diversification fails, safe assets decline, financial media frames it as an unexpected shock. But it won't be unexpected. The math is visible now. Here are the key signals to watch. US 10-year yield above 4.75% and holding there. That indicates foreign selling pressure is persistent. US 30-year yield approaching or exceeding 5%. That signals long-duration risk is repricing aggressively. Dollar-yen breaking below 140 decisively. That suggests rapid carry trade unwinding. If those levels are breached in sequence, acceleration follows. And if volatility spikes while liquidity thins, forced liquidation begins. The critical point is this: markets don't wait for confirmation. They move before consensus agrees. By the time headlines declare crisis, prices have already adjusted. This window, the next 3 to 6 months, is when positioning matters. After that, you're reacting, not preparing. And reacting in funding stress environments is expensive because liquidity disappears when you need it most. The system has been built on cheap funding for decades. That era is shifting, and shifts in funding regimes don't resolve calmly. They resolve through repricing. The timeline isn't years, it's quarters, and the math is already in motion. Positioning before the crowd. Now we get to the only part that actually matters: positioning. Not prediction, not fear. Positioning. Because once funding stress becomes visible to everyone, it's too late to adjust cleanly. You adjust when volatility is low. You don't wait for it to spike. Here's the uncomfortable truth. Most portfolios right now are built for stability. They assume bonds hedge stocks. They assume liquidity remains deep. They assume central banks can step in instantly. Those assumptions are fragile. So what does positioning look like when leverage is the problem? First, reduce exposure to rate sensitivity. Long-duration bonds are the most vulnerable asset in this environment. If yields continue rising due to foreign selling, long bonds fall hardest. The 30-year Treasury moves dramatically with small yield changes. When funding stress pushes yields up, duration risk gets punished. Second, understand which equities are most exposed. High-debt companies, unprofitable growth names, businesses dependent on cheap refinancing. These are fragile in rising rate environments. When borrowing costs jump, earnings compress. Refinancing becomes expensive. Balance sheets strain. That's where bankruptcies begin. Third, prioritize companies with fortress balance sheets, low debt, strong free cash flow, essential products. Energy, consumer staples. Select mega-cap technology with pricing power, not speculative hype. Real cash-generating enterprises. When liquidity tightens, survival matters more than growth narratives. Fourth, consider hard assets, not because they make you rich overnight, but because they are not someone else's liability. Physical gold and silver, limited supply assets. Assets that historically perform when confidence in government debt wavers. This isn't about betting against the system. It's about hedging systemic fragility. Fifth, manage liquidity intentionally. You don't want to be forced to sell into panic. That means maintaining enough cash or near cash instruments to avoid margin stress in your own life. No forced sales, no emotional decisions. Liquidity is optionality. But here's the nuance. Cash itself is not a long-term hedge. If central banks respond to bond market stress with renewed quantitative easing, liquidity floods back in, inflation reaccelerates, the dollar weakens, cash loses purchasing power. So liquidity is a bridge, not a destination. This environment is about balance: reduce leverage, reduce duration, increase resilience. The mistake most investors make is waiting for clarity. They want confirmation. They want headlines declaring crisis before acting. But positioning is cheapest before confirmation. Once volatility spikes, spreads widen, prices gap, liquidity dries up, and repositioning becomes expensive. The crowd reacts, professionals prepare. This is not about abandoning markets, it's about understanding funding cycles. When funding is abundant, risk assets thrive. When funding contracts, risk assets suffer. Japan's yield shift signals funding is tightening. That's the macro backdrop. Positioning accordingly isn't pessimism, it's math, and math does not negotiate. Now we arrive at the most important variable, the Federal Reserve. When funding stress accelerates, the market will look to one institution. Will they intervene or let the system clear? Here's the dilemma. If Japanese selling pushes U.S. Treasury yields sharply higher, financial conditions tighten instantly. Mortgage rates spike, corporate borrowing costs surge, equity valuations compress, banks face unrealized bond losses, pension funds face collateral stress. Pressure builds quickly. Historically, when stress builds fast enough, the Fed intervenes. They cut rates, inject liquidity, and restart asset purchases, known as quantitative easing. But here's the problem in 2026. Inflation is not fully defeated. Core inflation remains sticky, wage growth is elevated, and commodity prices are volatile. If the Fed cuts aggressively into rising yields and restarts large-scale bond buying, they risk reigniting inflation. If they don't intervene and allow yields to rise unchecked, markets break. That's the trap. They can stabilize bonds and risk inflation, or fight inflation and risk financial instability. They cannot fully solve both simultaneously. This is what makes this cycle different from 2008. In 2008, inflation was collapsing. The Fed had room to print without immediate inflationary consequences. In 2026, that margin is thinner. If they step in aggressively, the dollar weakens. If the dollar weakens, import prices rise. If import prices rise, inflation pressures return. Now imagine this sequence. Japanese selling pushes. Treasury yields toward 5.5% or higher. Markets wobble, volatility spikes, equities drop 15% to 20%, liquidity tightens. The Fed signals readiness to act. Markets bounce briefly. But bond investors question long-term fiscal sustainability. Yields remain elevated. The Fed must choose between defending bond prices or defending price stability. If they defend bond prices with large-scale purchases, gold and hard assets likely surge. If they defend inflation credibility by staying tight, equities and credit markets absorb the shock. This is why relying solely on central bank rescue is dangerous, because their tools are constrained. Markets have been conditioned for decades to expect rescue. Every dip bought, every crisis backstopped. But funding stress tied to sovereign debt is different. When the stress originates in the bond market itself, intervention becomes more complicated, because buying bonds to stabilize yields increases the monetary base, and increasing the monetary base in an inflation-sensitive environment is risky. This is the policy paradox. Stability requires liquidity, liquidity risks inflation, and inflation undermines bond confidence further. It's a feedback loop. The Fed may intervene partially. They may coordinate with Japan. They may provide currency swap lines, but they cannot eliminate the structural shift. Japan's funding costs have risen. Leverage must contract. That process cannot be printed away entirely. It can be softened. It cannot be erased. This is why positioning ahead of the decision matters, because once the Fed acts, volatility will already be elevated. And if they hesitate, markets will price that hesitation quickly. Either path involves turbulence. The era of frictionless liquidity is fading, and central bank policy now operates inside constraints. The assumption that the Fed can always fix everything is being tested. And markets do not test assumptions gently. They test them violently. What breaks first? In every funding crisis, something snaps. Not everything at once, something specific. A weak link, a pressure point. The question isn't whether stress spreads, it's where it surfaces first. Start with regional banks. They're still sitting on unrealized losses from prior bond repricing. When rates rise, the value of long-duration bonds falls. Those losses sit quietly on balance sheets until liquidity tightens. If depositors get nervous and move funds, banks are forced to sell bonds at a loss. Capital erodes. Confidence erodes. We've seen this movie before. Next, consider hedge funds running leveraged relative value trades. Many funds rely on repo financing to amplify small spreads in treasuries. When volatility rises and collateral values fall, repo lenders tighten terms. Haircuts increase, financing costs rise, positions shrink quickly, and when multiple funds try to exit simultaneously, liquidity evaporates. Then there's the mortgage market. U.S. mortgage rates are directly tied to long-term treasury yields. If the 10-year climbs toward 5.5% or 6%, mortgage rates follow. Housing affordability collapses. Real estate doesn't crash overnight. It grinds lower as financing dries up. That affects consumer confidence. And consumer confidence drives spending. Corporate debt is another fracture point. Trillions in corporate bonds need refinancing over the next few years. If rates remain elevated or spike further, refinancing becomes expensive. Companies with weak balance sheets struggle. Credit spreads widen. Defaults rise. High-yield markets freeze first. Then contagion spreads to investment grade. Markets rarely break in the strongest institutions. They break in the second tier, the firms with just enough leverage to matter. And when one fails, counterparty exposure surfaces. Confidence fades, liquidity contracts further. But here's the deeper risk. If treasury auctions begin showing weak demand, that signals foreign participation is declining. That's when the narrative shifts. From temporary volatility to structural repricing, bond market credibility matters. Because treasuries are the foundation of global collateral. If investors question who absorbs $38 trillion in U.S. debt, risk premiums rise. Higher risk premiums mean higher yields. Higher yields mean tighter financial conditions. And tighter financial conditions mean slower growth. The first break may not be dramatic. It may be subtle. A failed fund, a distressed bank, a disorderly auction. But once confidence cracks, repricing accelerates. Funding crises don't unfold smoothly. They move in steps, calm, then shock, then temporary stabilization, then larger shock. Each wave tests liquidity deeper. The carry trade unwind is not the entire storm. It's the pressure change. The storm forms around it, and markets always reveal the weakest link first. The only uncertainty is which link fails before the others. The math doesn't predict the exact casualty. It predicts stress, and stress finds cracks, always. This is not fear. This is math. Let's strip this down to its core. Japan's 30-year yields hit levels not seen in 3 decades. The Bank of Japan stepped away from artificial suppression. The carry trade, the foundation of global leveraged finance, no longer makes sense. That's not opinion, that's arithmetic. When funding costs rise, leverage contracts. When leverage contracts in a system carrying $15 to $20 trillion in exposure, assets get sold. Not selectively, Systemically, U.S. Treasuries face foreign selling pressure. Equities face margin-driven liquidation. Bonds and stocks can fall together when the hedge breaks. Mortgage rates rise. Credit spreads widen. Liquidity thins. This is how funding cycles reset. Not because investors panic, but because balance sheets demand it. The next 90 to 180 days matter. Watch the U.S. 10-year yield, watch the 30-year, watch dollar-yen, watch volatility. These are not abstract indicators, they are pressure gauges. And when pressure builds in funding markets, repricing follows. This is not about predicting catastrophe. It's about recognizing regime change. For decades, the system ran on near zero funding costs. That era is shifting. Shifts in funding don't resolve quietly. They resolve through volatility. The traditional 60-40 model may not hedge effectively. Leverage will unwind. The only question is whether you prepare before the crowd reacts. Hope is not a strategy. Diversification without understanding correlation is not protection. Liquidity management is not pessimism, it's discipline. This isn't fear, it's math, and math does not negotiate. If this breakdown helped you see the mechanics behind the headlines, and not just the noise, but the structure, make sure you're subscribed. The next analysis will map the specific trigger thresholds and the timeline that signals acceleration versus stabilization. Hit like so this reaches more investors who think they're diversified but aren't, and turn on notifications. Because in funding cycles, timing matters. Stay informed, stay positioned, and don't let a mechanical unwind catch you unprepared.